If you woke up this morning thinking everything was fine, you missed the biggest financial confession of the decade. While you were sleeping, the United States Mint quietly doubled the price of its silver coins. Not 10%, not 20%. They nearly doubled them overnight. The uncirculated silver eagle that sold for $91 last week now costs $169. And nobody is talking about it. The Wall Street Journal is not covering this. CNBC mentioned it in passing like it was a routine adjustment. Bloomberg buried it under a pile of earnings reports, but I am going to tell you exactly what happened, why it happened, and what it means for every dollar sitting in your bank account right now. Because this is not a price adjustment. This is an admission. This is the United States government telling you, in their own actions, that the official price of silver has been a fabricated number for years. Before we go any further, I need you to do something. Hit the subscribe button right now, turn on notifications. The information in this video is exactly what the algorithm is designed to suppress. If you believe the public deserves to know what is happening to their money, a simple click helps fight that suppression. This is not about helping my channel. This is about making sure this information reaches the people who need it. At 12:01 in the morning, Eastern Standard Time, on January 17, 2026, the United States Mint reactivated sales of its silver products after a multi-day blackout. They called it a repricing pause. What they did not tell you is that during that pause, they were scrambling to figure out how to explain away an 86% price increase without admitting the obvious. The price they had been charging was fake. Let me show you the math because the math does not lie. The Mint last updated silver prices on July 9th, 2024. That day, the London Bullion Market Association silver price was $31.05 per ounce. Fast forward to January 16, 2026. The LBMA silver price hit $90.80 per ounce. That is an increase of $59.75. That is a 192.4% increase. For 18 months, while silver nearly tripled in value, the Mint kept selling coins at prices based on $31 silver. Why would they do that? Because the moment they raised prices, they would be admitting that the entire pricing mechanism is broken. Here is what most people do not understand about silver prices. The number you see on your screen when you check the market is not the real price of silver. It is the price of paper contracts that claim to represent silver. The COMEX in New York and the LBMA in London trade contracts in volumes that are 100 to 200 times larger than all the physical silver that actually exists. They are trading promises, not metal. And for decades, this worked. The tail wagged the dog. Paper prices set physical prices, until now. As of this recording, COMEX is quoting silver at approximately $71 per ounce. But in Tokyo and Dubai, physical silver is changing hands at $130 per ounce. That is an 82% premium over the official price. This has never happened before. Not in the 1980 Hunt Brothers squeeze. Not in the 2011 spike. Never. The largest divergence between paper and physical prices in the history of precious metals trading is happening right now, and the financial media is pretending it is not there. Why does this divergence exist? Because the paper system is running out of physical silver to back its promises. Between early and mid-January, 33.45 million ounces of silver were physically withdrawn from COMEX for delivery. Let me put that in perspective. That is 26% of COMEX registered inventory. Gone. In 7 days. 1/4 of the metal that backs COMEX futures contracts disappeared in a single week. I have been watching these markets for years. I watched the 2008 crisis unfold. I watched the 2020 pandemic spike. I watched the meme stock silver squeeze attempt in 2021. None of those events caused this kind of inventory drain. What we are seeing now is different. This is not speculation. This is industrial buyers, sovereign funds, and institutional investors demanding real metal because they no longer trust the paper system. Let me explain how the manipulation works because once you see it, you cannot unsee it. The COMEX and LBMA operate on a fractional reserve system. For every ounce of physical silver in their vaults, they allow hundreds of ounces in paper contracts to trade. As long as most contract holders never demand physical delivery, the system works. It is like a bank that holds $1 for every $100 in deposits. Fine, unless everyone shows up at once. When silver prices start rising, the manipulators have tools to stop it. The most powerful is the margin hike. On December 26th, during what traders call Ghost Week because trading desks are empty for the holidays, the CME Group raised margins on silver futures from $22,000 per contract to $25,000. 4 days later, on December 30th, they raised them again to $32,500. That is a 47% increase in 4 days during the quietest trading week of the year when nobody was watching. Who benefits from margin hikes? The big banks with unlimited balance sheets who can absorb the higher costs. Who gets hurt? Smaller traders and speculators who get forced to liquidate their long positions because they cannot meet the new margin requirements. This is not a neutral regulatory action. This is a kill switch designed to protect the institutions that are short silver and losing billions. 8 banks have already paid $1.27 billion in fines for manipulating the silver market between 2008 and 2016. Traders went to prison. The manipulation was proven in court. And yet the same institutions are still the dominant players in the same markets. The fines were the cost of doing business. The manipulation never stopped. But here is what changed. China announced on January 1, 2026, that only state-approved companies can export refined silver, and only with special government licenses. China refines approximately 65% of the world's silver supply. With a single policy change, they effectively ring-fenced most of the global refined silver supply. This is not about trade war posturing. This is China preparing for a world where silver is a strategic asset more valuable than semiconductors. Why would China do this? Follow the logic. Silver is essential for solar panels. China dominates solar manufacturing. Silver is essential for electric vehicles. China dominates EV battery production. Silver is essential for electronics. China dominates electronics manufacturing. By restricting silver exports, China is ensuring their own industrial supply while the West scrambles. Now let me connect the dots to something the media wants you to think is unrelated. Greenland. President Trump is threatening 10% tariffs on European allies starting February 1st, escalating to 25% by June 1st, unless Denmark agrees to sell Greenland. The media is presenting this as Trump being Trump. Erratic, unpredictable, maybe a little unhinged. But the media is lying to you. Greenland contains an estimated 36 million metric tons of rare earth elements. Neodymium for magnets, dysprosium for electronics, lithium for batteries, and, critically, germanium and gallium. Germanium is essential for fiber optic cables. Gallium is essential for semiconductors, data centers, and quantum computing. China currently controls 98% of global gallium supply and 60% of germanium. If the United States does not secure alternative supplies, every piece of advanced technology in America will depend on Chinese goodwill. The Greenland conflict is not about territory. It is about the same thing the silver manipulation is about. Resource control as the foundation of monetary power. The dollar's value depends on American military and economic dominance. That dominance depends on access to critical resources. China is systematically cutting off that access. Silver, rare earths, processing capacity. The dollar is being squeezed from multiple directions simultaneously. Here is what they do not want you to calculate. The dollar fell over 9% in 2025. That is the worst annual performance since 2017. In the first half of 2025 alone, the dollar fell 11%. The worst half year since 1973. United States federal debt now stands at $37.3 trillion, a record. Morgan Stanley projects another 10% decline in the dollar by the end of 2026. Now watch this. Silver rose 210% while the dollar fell 9%. Do you understand what that means? The market is telling you that physical silver is becoming the benchmark of real value, while the dollar is becoming a depreciating IOU. The mint doubling prices is just the official acknowledgement of what the market already knew. Who is selling silver right now? Nobody with any sense. Who is buying? Central banks, institutional investors, industrial manufacturers desperate for supply. Who is holding paper promises and watching their purchasing power evaporate? The people who trust the mainstream narrative. Let me walk you through the inventory situation because the numbers are terrifying. COMEX registered silver inventory has fallen 70% since 2020. London Bullion Market Association vaults have lost approximately 40% of their holdings. Shanghai inventories are at their lowest level in a decade. Globally, the silver market has been in structural deficit for 5 consecutive years. The cumulative deficit from 2021 through to 2025 is approximately 820 million ounces. 820 million ounces. Let me put that in context. That is nearly the entire annual mine production of the world. For 5 years, demand has exceeded supply by an amount equal to a full year of production. Where did that silver come from? Existing inventories. Inventories that are now critically depleted. The 2025 deficit alone was 230 million ounces, equivalent to the entire annual production of Mexico, the world's largest silver producer. And 2026 is projected to continue the deficit, driven by investment demand and industrial usage for solar panels and electrification. Let me ask you some questions. If the silver market is so well supplied, why did COMEX need to raise margins 47% in 4 days? If prices are fair, why is physical silver trading at 80% premiums in Asia? If the mint's old prices were accurate, why did they need to double them overnight? If paper silver is as good as physical, why are institutions draining COMEX inventory at record rates? If the dollar is sound, why is the government threatening to start a trade war with NATO allies over mineral deposits? If everything is under control, why does every action they take look like desperation? These questions answer themselves. The system is not under control. The system is unraveling in real time. Let me tell you what comes next. In the next 7 days, silver remains scarce but available at current premiums. Dealers still have inventory, but premiums are 70 to 80% over spot. More COMEX withdrawals are expected. Trump continues escalating on Greenland. The dollar remains under pressure. In 7 to 30 days, the 10% tariffs on European allies take effect on February 1st. Expect retaliation. COMEX inventory could reach critical levels if withdrawal rates continue. February futures contracts face potential delivery failures. Smaller dealers begin running out of physical metal. In 30 to 90 days, if inventory drain continues, COMEX faces an existential crisis. The divergence between paper and physical prices could exceed 100%. The Greenland situation could escalate dramatically as 25% tariffs loom on June 1st. Silver physical prices could reach $150 or higher. The dollar likely accelerates its decline. Beyond 90 days, we enter uncharted territory. A new pricing system for silver could emerge based in Asia. COMEX and LBMA lose relevance as price references. The dollar loses reserve status in specific commodity markets. Physical precious metals become inaccessible to middle-class buyers. Those who converted early preserve their wealth. Those who waited lose everything. Now let me speak directly to you. Where are your savings right now? In a bank account paying 2% while inflation runs 10% or higher? In a 401k invested in stocks and bonds denominated in a currency losing 9% per year? In a silver ETF that gives you a paper claim on metal you can never touch? Here is what you need to understand about ETFs. When you buy shares of SLV or SIVR, you are not buying silver. You are buying a contractual promise from an institution to track the price of silver. You cannot take your shares to a vault and exchange them for metal. If the paper system collapses, if COMEX defaults, if the whole fractional reserve structure falls apart, your ETF shares become a claim on nothing. They go to zero while physical silver goes to the moon. Let me give you a concrete example. Say you have $10,000 in a silver ETF today. If silver goes up 50%, your ETF might go up 50%. You now have $15,000 on paper. But if during that rise the COMEX defaults and the ETF cannot meet redemptions, your 15,000 becomes zero. Meanwhile, someone who bought physical silver with their 10,000 now holds metal worth 15,000 that they can actually touch, sell, trade, or pass to their grandchildren. This is not theoretical. The numbers I showed you, the inventory drain, the margin hikes, the divergence between paper and physical, these are the warning signs of a system approaching failure. Maybe it fails in 3 months, maybe it fails in 3 years, but the trajectory is clear, and when it fails, the transition will happen fast. I want you to think about what happened to ordinary citizens in past monetary collapses. In Weimar Germany, people who held savings in marks watched their life savings become worthless in months. Families who had worked for generations lost everything because they trusted the currency. In Venezuela, people who held bolivars saw 99.9% of their purchasing power evaporate. People traded wedding rings for groceries. The United States is not Weimar or Venezuela, but the dollar is not exempt from the laws of economic physics. A currency backed by nothing but debt and promises will eventually reflect the quality of those promises. When the United States government is simultaneously manipulating commodity prices, threatening trade wars for mineral resources, and running $37 trillion in debt, the quality of those promises is declining rapidly. Here is what you do. First, this week, contact a reputable precious metals dealer and convert 10 to 20% of your liquid savings into physical silver. Not certificates, not storage programs. Physical metal in your possession or in a vault you control. Second, audit your retirement accounts. Understand exactly what you own. If it is all paper claims, consider diversifying into physical assets. Third, stop trusting mainstream financial media. They work for the institutions that benefit from your ignorance. Fourth, share this information. Tell people you care about. The more people understand what is happening, the harder it is for the manipulation to continue. Fifth, subscribe to this channel and turn on notifications so you can stay informed as this situation develops. Let me tell you what not to do. Do not wait for the perfect time. There is no perfect time when an 80% premium overspot seems like a deal compared to no silver available at any price. Do not trust paper. Not ETFs, not certificates, not allocated storage programs with fine print that says they can settle in cash. Do not assume this will blow over. Every metric is pointing in the same direction. Do not believe that because it has not collapsed yet. It will not collapse. Empires fall slowly, then all at once. The window is closing, not metaphorically, literally. 130,000 silver products sold by the U.S. Mint in a single day. 26% of COMEX inventory gone in a week. 65% of global refined supply locked behind Chinese export restrictions. Dealers with waiting lists. Premiums at historic highs. Every day you wait, there is less metal available and higher prices to get it. I have given you the data. I have shown you the mechanisms. I have connected the dots between silver, Greenland, rare earths, and the dollar. What you do with this information is your decision. But ignorance is no longer an excuse. The price just doubled while you were sleeping. The government told you what they really believe about the value of silver. Are you listening? Your savings are your responsibility. The clock is running. And when this window closes, it does not open again.